think the internet's running slow.
Please like and leave a heart. Please.
There we go. Oh, dang it. I'm out of practice. Good gosh. Hey, everybody. Welcome to the Vidor Locksmith Show. I'm your host, David Gibson. We're unlocking the secrets to success in the oil and gas industry. One interview, one technical presentation, and one technical screw-up at a time. Starting late because we got the technical screw-ups going on before we even got started here. So trying to get everything back on track with the show this morning. Had a great day at NAPE yesterday. Did a lot of stuff with the camera and some of the other film equipment here. And I'm pretty sure that's what was messing some of the stuff up this morning, but had to do a quick restart of the computer, just turn it off, turn it back on, and then everything should work just fine. Got an absolute amazing show set up for you guys today. Really, really excited about it. Hopefully everything's coming in clear. Guest today was saying that it looked a little bit blurry. It's blurry. I don't know what to say. Ooh. All right. How can we troubleshoot this? And turn off everything you've got connected to the internet. Turn off my phone. Make sure nothing on it's connected to the internet, because that's what I'm getting the signal on. How blurry is it?
It's not that blurry. I mean, it's.
All right.
Rob's going to be doing a presentation. So.
Yeah, blurry. All right, guys, how about this? Give me just a minute, and the one video of you is blurry. Logos are clear. I'm blurry, but the logos are clear?
Yes, here, I'll pull it up
Troubleshooting.
so you can see.
Okay. So how in the world is my camera on here look perfectly good, but not there?
It looks perfect here.
This makes absolutely no sense.
Is it on the wrong setting, maybe? Back here.
I don't know. How about this, guys? Hopefully Robert looks clear. He's the guest of the day. And yeah, we'll please keep giving me feedback. The feedback loop needs to be pretty quick this morning. So, guys, let me know where you're watching from. Hopefully you can hear me just fine. But we'll try it. I don't need to be in focus. I can be Bigfoot for all I care, right? So here we go. Rob, thanks for being on the show, man. Hopefully your portion of the screen comes in nice and clear. If it does, then we'll just leave you up. Nobody's here to see me. They're here to be able to see you. So if everything's working fine there, then we'll just kind of go with it.
Yeah. In the energy patch, there's always issues to work around. But most people probably came for the slide, so I think the slide should be good to go.
All right, well, here, Rob, first of all, thank you for being on the show today. I'm really excited to have you as a guest. Been following your stuff. I was doing a research project, came across some of your stuff, absolutely fell in love with some of the things that you're doing. Give us a quick breakdown of who you are and what you do before we jump into the slides.
Yeah, sure. So the arc of my story began, I guess you could say, 22 years ago. I was fortunate enough to have what I think is probably the best mentor you could ever have for not just commodity cycles, but, stock market cycles, equity markets, what have you. And one of the things he would have me do was we would rebuild the financial histories of these companies. So I'd find these old annual reports. I mean, you can't download this stuff. You have to physically find the report. And I would rebuild the histories of Exxon, Chevron, and what have you. And, fast forward to COVID and and at that time, the business I was running was shut down, but a lot of things started happening again with a lot of things he taught me 20 plus years ago. So I said, let me start putting out some of this content and just see what happens. So started doing that on social media, and then one thing led to another. And then, finally I made it big by being invited by Dave Gibson to be on his show. So so that's what I do. I guess if you follow me on Twitter, LinkedIn a little bit, but my Substack, I'm the guy who, has all this old energy data, financial history data to basically tell the story of these companies in this industry.
Well, I'll go ahead and bring up your slide deck, let you go ahead and get started with it. I'm super excited to be taking notes. I will be doing just a little bit of troubleshooting on my camera and my setup in the background real quick to hopefully be able to come back to it. But I'll let you go ahead and kick this thing off, man.
Yeah, sure thing. So I'm going to actually sort of skip around a little bit on this slide deck. And I believe Dave also has a copy of this and can send it to you. I have updated a couple slides since then. You can see this was actually my 1Q25 chart pack that went out in December. I'll have a new one coming out here soon. But, I guess a good place to always start, and what people love about my stuff, is just the cycles and the history. And we'll talk a little bit about some of the macro drivers for just commodity cycles as a whole. And I'll get into what I think are the drivers of oil. We can talk a little bit some of the near-term type stuff, and we can sort of run with it from there. But the number one thing that I learned about, and this is very different than you'll see in a lot of my work, I'm not much of a barrel counter. So I don't, project demand. I don't project supply to see where inventories are going. And there's a couple of reasons for that, and one of them is this chart. And the point of this chart is that excessive money creation is the underpinning and the foundation to every commodity cycle going back well over 200 years. And what you'll notice about this chart is what I'm showing here in the dark black or dark blue line along the left axis is an all commodities index on a year-over-year 10-year moving average. And the green line is world M2 or world money supply expressed in US dollars. And a long time ago, I read this book by a funky economist, Warren and Pearson wrote this book called Prices. And I wasn't the first to discover this, but what they noticed, if you know the history of Warren, he was actually this funky economist that FDR brought into his administration to help fix the deflationary period that was going on in the 30s. And they would literally adjust the price of gold. And it was him. He knew, and what he discovered was this light green dotted line is that when excessive money started circulating in the economy, that would lead to commodity inflation cycles going all the way back to the founding of the country. And you can see it right here. And the biggest driver to excessive money creation and thus commodity cycles is governments. Money is created via two ways. It's either created through the banking system via the credit creation cycle, or governments just print money. And governments will print money for two reasons. They either need to finance a war that they know they can't pay for via taxing people, so they just suppress money or suppress central banks' ability to regulate the creation of money, or they will create money to fund a social spending program. That was the driver of the 70s inflation cycle. You can see there the Great Society. So fast forward to today, and I hear things about the energy transition, and to me that's just another social spending program. And we have wars raging around the world, so it's a pretty bullish backdrop for the long term for commodities. And if I have an updated version of this chart, but when you go through one of these commodity deflationary cycles, like from the Civil War through the 1890s, if you know your history, that was in 1894 was the rise of William Jennings Bryan and the populist movement. FDR was a populist, and the New Deal was another populist movement. in the 60s, after a period of commodity deflation, you had the rise of Southern populists in the form of LBJ. And I think that's what we're seeing again. The populism is in vogue. Trump is a populist. Biden tried to be a populist. He pivoted. And so that's what we're seeing again. And, skipping forward, this is my mentor would always make me read, and you had to know your history. And so he would, make me, I've probably read The Prize like 6 times. If you don't know, it's sort of like the Bible within, oil and gas history. But another book I highly recommend is The Seven Sisters, if you haven't. But in all the readings that I've done around this industry, is I started to notice regular patterns that occur in these cycles. So what you're looking at here, these are the petroleum cycles. There has been 5 previous ones since the founding of this industry. We're currently in the 6th. So the way to understand this chart, we're not going to go through it all. This podcast is long enough for it. But every column,
no, it could definitely be long enough if you want to go through it. We've got all day. I know you've got other things on your plate today, but
yeah. So every column is a cycle. Okay. And every row, think of it as a stage in a cycle. All right. So what I've noticed in studying this industry for 20 plus years is that this is my interpretation of history, is it goes through 6 separate stages. And these have been present in every single cycle since, oil was, first discovered in the foothills of Pennsylvania. And stage 1, think about this as sort of like the peak. Stage 1 is like the peak or ending of a cycle. Is typically a war ends, a global conflict comes to an end. You have a flood of new supply, demand slows, and then oil capitulates. Well, after oil capitulates, then you go through stage 2, which is instability in oil producing regions. So and then after that comes stage 3, and that's where I think we're in the latter stage of that. That's low capital spending and consolidation of the industry. Stage 4 is actually debasement of the currency. I think this is coming next. We also saw whims of that in the post-COVID reaction too. And then all the fun stuff for all of us, where most of people fall in and start to get on board with this, is stage 5 and 6, which is a new demand hub, and another global conflict arises. And then what I call Hubert's peak, or fears of running out of supply, like these things that I read about peak demand start to transform into peak supply. And this goes all the way back to the fears of peak supply, go all the way back to the days of Standard Oil, when he said it was Rockefeller's predecessor. I'm blanking on the name. I believe it was not Archibald, but it could have been, where he said, I'll drink every drop of oil west of the Mississippi, before they discovered things in Texas. So the other common question I get about this is, how long do we tend to spend in a stage? And history's not that, how you could say, it's not that kind to give us such a, an easy to follow roadmap. But the thing I always point out to people is, each stage doesn't have, say, 4 years or 5 years or what have you, but you can never go from stage 1 to stage 4. History has never shown that we skip over something. So this consolidation that you're seeing within the E&P and the North America patch, it's the same thing that happened in the era of the super majors in the late 90s, early 2000s. And then before that, you saw the Seven Sisters consolidate the Middle East production. And if you want to go all the way back to Standard Oil days, the Cleveland Massacre, which was when basically Rockefeller consolidated the entire refining industry to control 90% of it. It's nothing new, and that's exactly where we are. So what does the future hold? I think it's pretty good. I've been out there and I've been saying lately in a lot of the content, I think the S&P 500, energy will be probably one of the best performing sectors in the S&P 500 over the next decade, and will probably, I think, be the pants off of it. And why do I say that? That's hard to say right now because everything's just, mega tech these days. Although actually since December and even as after these latest earnings reports, tech's shown a lot of cracks in it. But there's this beautiful quote by one of my favorite strategists, EM economist / strategist, Louis Vincent Gav of GavCow. He says that economic activity is nothing more than energy transformed. And I love that chart because economic activity is GDP and energy is basically oil and gas, coal, nuclear, what have you. But if you actually take, which is this blue line, energy's market cap divided by GDP, it's the best predictor for where the next 10 years real total returns for energy will average out to be. It's the best predictor on a monthly basis going back to the breakup of Standard Oil in 1912. It has an R squared of about 0.62. I did okay in stats in college. I think I barely scraped by with a B minus, but 0.62 is good enough for me. And the way I show that is this blue line along that left axis takes my Crude Chronicles energy index. If you have questions about that, how I built it, it was a timely 2-year process. But if you take that and divide it by US nominal GDP, it oscillates for well over 110 years between 3% and about 13% on the left axis. What the orange line tells you is, okay, let's just zoom back to, we'll call it June of 08 when that line peaked, energy was trading at 14% of nominal GDP. The orange line says, okay, here's what performance did if you bought at that time, what the next 10 years. So that's why it looks like the line lags. And it says, if you bought at that time, you compounded after inflation price plus dividends at 1% per annum. It's pretty paltry, and you definitely didn't keep up with the S&P 500, which did over 13% per annum in real. But what it's saying right now, and this chart has since been updated, that blue box has actually moved down. It's saying that we're probably going to do, if this correlation holds, we're going to do anywhere from 8 to 10% per annum over the next decade on average. Now, that's on average. We will have years where we'll be above. We'll have years where we will be below. But over the next decade, price plus dividends should average out to be there. And, it is a great inflation hedge as well, which we can talk about going forward. So I think it's going to be a much, much, much better decade than it will be what it has been. The beauty of this chart, too, is that if you locked in there in the COVID lows and just went all in, I only know of one, famous sell-sider who's made some of the best calls of the last, say, 20 years. He went long energy literally on the day that energy bottomed relative to the S&P and relative to nominal GDP, going back well over 110 years. And this chart says his call locked in 14% per annum real returns over the next decade. So I'm pretty bullish on it going forward. Now, it has been a rough 2 years. And why has it been a rough 2 years? Is because, I'm sorry, these cycles are never, ever linear. They never will be, and they never have been. That's the point of this chart. And what this chart shows you is this is the super majors. Okay, so it's their returns on equity. So just net income divided by shareholder equity, going all the way back to 1882 or Standard Oil. And that's that blue line along the left, all the way on the far left is Standard Oil Trust. But you also have ExxonMobil, Chevron, Shell, Royal Dutch, Shell Transport, Shell TNT, BP, Total, and ConocoPhillips. And the beauty of this chart is it's reconstructed to include all of the companies they bought. Okay, so it's pretty darn good look at all of them. So that Exxon has Mobil, BP has the old Amoco and Arco in it, the Conoco and the Phillips and what have you. So these cycles move in waves, three waves up, and if you actually examine closely, 3 waves down. And this was taught to me by a technician. It's market psychology. this technician, Alan Shaw, said markets, you can see this. Gold did this in the 70s. Housing stocks did this in the 2000s. Energy stocks here did it in the 2000s. Tech stocks are literally, NVIDIA is literally doing it now until recently, but they move up in three ways. They're called disbelief, pullback, belief, pullback, greed. And they move down in three waves. They go disbelief, rally, belief, rally, capitulation. And if you examine the 08 to 2020 period, we went down in three waves. 08 to, 06 to 08, we rallied. And then 14 through 18, we rallied. And then 18 to 2020 was capitulation. But I've returned I call it the dope cycle because it's addicting to investors as it takes time. It's called doubt, optimism, parabolic euphoria. And I just merely think that 2020, 2022 was the doubt phase. It's been done before. It's been done 5 times before. And that's where we've been. And we've been just in this 2-year pullback. So after this comes the optimism, and then a pullback. And then the last one where literally everyone piles in is parabolic euphoria. And that's where I think that tech just spent the last 2 years completing, whereas energy spent the first leg of its cycle in the pullback sort of phase. So like David, if I showed you a chart of, say, Schlumberger in the 70s versus NVIDIA now, relative to the S&P 500, they're identical. They are literally identical how they are acting on relative performance. And I've done a post a couple months back about that. But the important thing about these cycles
goes over to LinkedIn and starts looking for that now.
Yeah. But the important thing about these cycles is I consider this my number one chart in all of commodities. And I use this as a barometer to really, try and get a sense of, are we peaking? Are we troughing? And this is why I sort of started doing all this content again, because we started troughing in early 2020. And what I show you here is this is oil divided by the S&P 500 monthly back to 1859. And what you tend to find is these cycles on average. Well, let me backtrack. This chart is important because it also has big macro implications. It's the hard asset versus paper assets. It's stocks versus commodities. It's value versus growth. It's energy versus the S&P, old economy versus new. And so it even has implications for, other markets, such as currencies, such as treasuries and what have you. But the point about this chart, without getting, ahead of myself, is that we trade price leadership, oil versus the S&P, commodities versus stocks, every 12 to 13 years on average. And the bear market that we were in from 08 to 2020 was a typical 12-year bear cycle along the way. And we hit the bottom end of that range in 1Q 2020. We had a strong rally back to the midpoint. But then again, like that last 2 years, it's been rough and the bears are piling on. But as of late, oil versus the S&P, if you were to really zoom in on this, it has started to tick up a little bit lately. And so I think we're only 4 years in a classic 12 to 13 year up cycle. And that's why I'm staying bullish now. If you say when I would get worried, it's when we get to the top end of that trend. Also, I will say, you see these charts floated out there, like, energy was 30% of the S&P in the 70s. So it's like, well, oil versus SPX was at a much higher range, and ExxonMobil and Chevron produced many, many more barrels than the 4.5 million BOE per day it does today. So will we ever get to, the 70s type weighting? No, like human ingenuity is that we become actually less energy intensive, which is a good thing. It's a good thing. But every 12 to 13 years, energy does make a comeback due to malinvestment and other factors. So, if you are an inflationist, or that inflation is bottoming and you need some, hedging for your portfolio in the long run, the beautiful thing about energy is that, yes, its multiples will compress with inflation, but it won't compress by as much as the market. And The way I try to show that here is this is energy's cyclically adjusted PE, or what's commonly referred to as a Shiller PE. And what that basically is just taking the price divided by a 10-year smooth average of earnings to smooth out the cycles. But if you take energy's CAPE, or energy's Shiller PE, divided by the S&P 500 Shiller PE, you get these blue lines. Okay. And when inflation is rising, energy gets a better multiple than the S&P 500 or the market when it's rising. And just tracking back to the last couple times where we had inflationary bouts, you had the post-World War II period, the Fed Treasury Accord, and then you had the 70s in the upper right. In the 2000s, the 2000s actually wasn't that inflationary to the US. It was more so on the global stage, but you can see here that energy's relative CAPE did a better job at protecting asset values than the market as a whole. And from what we're seeing here, energy or inflation could be, the Fed's target at 2% seems to me like more of the bottom rather than the long run average. So if you are in this camp that like energy's ROEs, that also inflation moves in waves, then, this is a great way to hedge your portfolio for the long run. So I'll sort of skip over this, but, David, we could stop there if you have any questions, or I can, just sort of run through it for the next couple slides. Your call, man.
I mean, we haven't gotten any questions.
Your camera looks a lot better.
Well, thank you. I think all we need to do is just turn it off and turn it back on. So we had to do it to the computer and to the camera. So good to know that's I'm not just a out of focus creature. I haven't seen any questions come in yet. Will say for everybody that's watching, if you guys do have any questions, this is an excellent opportunity to be able to ask Rob some questions. This is obviously somebody who we're mainly technical drilling focused group of individuals. So usually not getting this level of monetary education, I guess you could say. So phenomenal to me. I'll let you just keep going. I'm just trying to keep up because this is a lot to be able to take in, but it's good stuff to know.
Well, David, like the one thing I learned is like, if you have a question, or if you're like, hey, I didn't really get that, can you re-explain it? Like, there's probably a lot of other people who think so too. And, I look at this stuff all day long. So, and I understand that the audience is probably seeing some of this for the first time. So if a question pops up where you're like, hey, I didn't quite get that, like, I can go back and maybe try and rephrase it.
That would be a 40-hour a week job. I'm just going to let you know.
All right. Well, I'll keep rocking and rolling, man. But if you just ever want to stop me, like, hey, I don't get that, just let me know.
Okay.
So,
okay.
I'm a lot different, or I have different views about what sets oil prices than, I guess you could say, consensus does. And that was sort of born out of a little bit of frustration in my earlier years. So you'll see these charts floating around, whether it's published research coming out of investment banks, or whether it's on where everyone tells the truth on Twitter /X, where no lies can ever be found. But you'll see these charts floating out there about, and I've done them, like, if you simply look at, and I've gotten in arguments with economists from famed very reputable institutions over it, and I'm just like, the historical data like just doesn't match up with sort of what you're saying. But my point is, I don't think over the long run supply and demand move prices as much as consensus likes to give it credit. That's a very controversial saying. Okay. Now, I don't want to confuse anyone to the fact that, is he saying supply and demand don't matter? No, that's not what I'm saying at all. So, because there's this thing called reflexivity, and if I'm trying to phrase it, it's a George Soros's theory, is oftentimes when there's sort of a forecast out there, okay, that market participants will look at the forecast and make decisions and adjustments based on that forecast to where at the end of the day, things don't live up to expectations, okay? Now, what do I mean by that is, yes, oil prices will move if forecasts change, but over the long run, what you tend to find is demand and supply actually tend to match each other pretty well because markets are moving based on a forecast. So I know it's a very complex topic, and I'm working actually on some content to explain it more, but let me just show you where I'm coming from. Is that when I was a young associate, I would say, and coming up during this, if you look over on the right here, what you're looking at here is in the blue line, in the orange line is oil demand and supply growth since 1866 on a year-over-year basis. Okay. And the reason why I spent, a couple years trying to find data sources to rebuild this to my best capabilities is when I was a young analyst, I was like, okay, we got this China bull cycle going on. Everyone tells me that when inventories move inversely to oil prices and they forecast inventories based upon demand versus supply. So let me reverse engineer this. And if demand is rising faster than supply, prices should go up, right? Makes sense. And if supply growth is rising faster than demand, prices should fall. Makes sense. But I just wasn't finding that in the historical data. I just wasn't. Like, I'm sorry, I have a lot of data and I just wasn't finding it. What I was actually finding when I could finally rebuild this chart going all the way back is the two are pretty similar lines, okay? But yet, if you look over on the right, we get these massive secular moves in oil, right? Like if you look at the 70s, oil going from just above $20 a barrel, inflation adjusted, all the way to close to 150. But if you look in the 70s, demand and supply closely matched each other. And then again, in the last China cycle, we went from, as low as $10 a barrel all the way up to 148. But demand and supply closely match each other. And it's mind-boggling. So let me just, if we were just to single out this, if you want to call them the super cycles, the secular bulls, basically whenever oil prices have gone from trough to peak, so trough to peak, trough to peak, trough to peak, okay? If we were just to single out those periods, you get charts that look like this, okay? The lines look the same, okay? Let's just go back to the one we all know, the China EM cycle, 98 to 08, one of the best runs in oil, is the blue dotted line. And this is like BP EIA data, okay? Is that demand and supply closely matched each other. They closely adjusted. The 70s super cycle, I mean, this was like the cycle of them all right? Very few people know this, but we went into the era growing at 8-9% per annum in oil demand. We exited growing -3. And in a non-recessionary type world, it was actually 1% there in 79 going into 80. It decelerated over the whole period, and demand and supply closely matched each other. But yet, if we look at on the previous chart, prices had a mega run, went up 10x. So now again, to repeat this, is that, so what moves prices, I think in the short run, is expectations, but then market participants reset what they're doing according to those expectations to where demand and supply just move with each other. Does that make sense? I know it can be a complicated subject. So it's just, if anyone knows anything about, George Soros's theory of reflexivity, I mean, the oil markets is pretty much it. And so what moves oil prices? And I know, you were at NAPE and there's a lot of probably, more technical people within this. It's if supply and demand tend to match each other pretty well, it's the cost of the incremental barrel to meet demand that moves prices and sets the floor on prices. That's the point of this chart right here. So when
say that one more time. The incremental cost.
Right. Okay. So let's just say we'll pick a company, like ConocoPhillips. Okay.
Okay.
Let's say they produce a barrel, right? And they sell that barrel on the market. So theoretically, unless they're going to go in blowdown mode, they have to replace that reserve, right? So let's say 5 years ago, it cost them, I don't know, $5 to replace that reserve. But then fast forward today, it costs $10 to replace it, right? So the replacement value went up. So are they going to sell that at the same price as 5 years ago? No, they're going to need to sell it at a higher price because they have to cover a cost of capital. Make sense?
I got you.
So that, just thinking about replacement values. And I wasn't the first to discover this. An economist named Marcus Adelman, you can Google his paper, User Costs in Oil Production, discovered this. And Adelman set out and he completely debunked the entire peak supply theorists in the 70s. But what he noticed is he put together this development cost index, and that's the orange line. So this development cost is basically a cost to replace your supply or your reserves, to find new reserves. And that tended to drive the blue bars in the background, which is the real price of oil, the inflation adjusted price of oil. And he unfortunately ended his work in the early 80s, his index. But fortunately for us, is these oil companies started disclosing reserve data to where we can reconstruct this. Beginning the first year you can actually get any data around reserve accounting is 78. So that lighter blue line is my development cost index. And lo and behold, what you find is that, so you have oil prices in the bars along the right axis, development costs. Think of this as just replacement values, or the value to put a barrel of reserve on your books to develop it is along the left axis. Is that what you find is that development costs, when they're rising, they provide a higher floor for it. And when they're falling, i.e. competitive dynamics are happening, industry is racing faster to get a lower priced to develop their reserves, right? We all talk about these productivity gains. This is it. Like, this is it. And so what drives, so the real question is, to me, is supply and demand closely match each other because the market is making decisions out there. Then what are development costs doing? And what's the driver of development costs? And this gets into a very contentious subject right now. But the driver of development costs is actually well productivity. And like, how much as an industry are we obsessed with well productivity at the moment? Like, we all are, the peak supply theorists are saying shales are peaking, whereas you talk to guys in industry, particularly on the service side, like, no, we're not. I am just merely of the view that it's not shales that are peaking, but the well productivity growth rates. That's a different argument. That's the second derivative, the productivity growth. So for example, if you were growing at 15% per annum, but then the next year you grow 10, and the next year you grow 8, and the next year you grow 7, your growth rate has peaked. It doesn't mean you peak. You're still going. You're just not going. You're not accelerating. And it's at the margin that markets care about. Okay. It's the margin. It's the marginal barrel. So what you find here is this is well productivity growth. And the simple way to measure that is actually, it's pretty cool. It's, if you go back all the way to the 1930s in these annual reports, they started giving us active well count data. And they had to do it back then because if you know your history, they were forced to shut in wells by the Texas Railroad Commission to protect industry. So they always had to publish the number of producing wells. So if you were to divide production by divided by number of producing wells, you got a productivity metric that goes back in time. And I mean, quite frankly, like it makes sense. If more is not coming out of, there's many ways industry measures productivity. I've seen it production per foot to standardize it, all this other stuff. But if more is not coming out of the hole in the ground, then it's just less productive. You need more holes in the ground. And so what you tend to find here is the orange line is well productivity growth on a 3-year smooth basis. And then the blue bars is, again, development costs, the cost to replace old reserves that you just produce, right? Something went out the door, something needs to backfill it, theoretically speaking. And that well productivity growth here peaked in 1970. Two things happened there. US did peak, but then also beginning at that time is that OPEC nationalized some of the most productive wells in the world. But around that time, what the industry had to do is they had to turn to other basins, higher development costs. So the floor for oil was rising. Okay. But then same thing happened in 98, well before China joined the WTO and people started worrying about demand issues related to China. Well, productivity growth peaked. My friend Arjun Murti, he tells these stories in a lot of his Substack that he would make these, supply forecasts, but his non-OPEC supply kept missing his forecasts. Well, productivity growth peaked in the non-OPEC world. So development costs at that time started to rise. Well, what happens is that after, a long period of development cost rise, people call it tier 2, tier 3. I mean, call it whatever you want, but these other basins start to get competitive for capital. They couldn't compete for capital in a 750, replacement cost world, but they can compete at $20, $22.50 offshore, Canada, what have you, shales, right? And so what happens is industry piles in, the competitive dynamics take over, and they work to lower the costs. And that's the productivity cycle that particularly the OFS industry has been struggling with. But I think their days of struggling with it are coming numbered. If you look here, well, productivity growth peaked in 2019, and development costs are still rising to that point. So, this is not the first time it's peaked. It won't be the last. Oil prices will rise again. It'll be able to, usher in capital investment into a new region, and we'll go through this down cycle once again. So the Permian, we're all watching the Permian, right? And you guys have, your audience probably has more boots in the ground. I'm based in Maryland, I want to get down to the Permian. I think I have a lot of subscribers. I have awesome people down there. But if I looked at proved developed F&D costs, so if you know your reserve accounting, and it can be complicated, I've had to learn it over the last 3 years, but oil companies will have reserves, right? And typically speaking, there's 2 buckets. There's proved undeveloped, i.e. we haven't sunk any capital into it, but we can carry it on our books because our reservoir engineers say there's stuff there. I don't mean to insult any reservoir engineers, like very smart people, but just I'm dumbing it down for my own capabilities. But then we have this nice slug called PDF&D, or proved developed, which means wells have been sunk, capital has committed. We're more sure of that because we have committed capital. And that's called proved developed, finding a development cost. And so what I show here on the left is the Permian. It has been the epicenter of this deflationary productivity boom and this down cycle in development costs, which has also pulled down oil prices, or did pull down oil prices from 2008 to 2020. But if you look at the pure play Permians players that are left, say that 5 times fast, pure play Permian players, that are left, development PDF&Ds have started to rise. Is it a long-term trend? Don't know. I'll get the 10Ks here. Only a couple of these guys are left, obviously DiamondBack and Permian Resources, but the trend has started to rise. And if you know, the Dallas Fed Energy Survey is one of the few places where we can get a intra-year look at this. And on the right here is that most of the net respondents are still saying that they are seeing increases quarter over quarter in PDF&Ds. Or excuse me, not PDF&Ds, but what they say is F&Ds. So like the next question is like, okay, this is nice. Like you actually see this and are seeing this play out in oil markets. And we saw this play out in oil markets last fall. I'll actually skip back to the first slide. Here is the best way to think about, I think of oil sort of two ways. Is there the upside, and I can get into it, but the upside is probably driven by global money supply / credit creation. I got a great chart on that. But the downside or the floor for oil is driven by replacement costs or replacement values. And that's what I try to show. And that's the point of this. What you're looking at is the replacement costs are rising. Okay. And over here on the left, I've had some of the best reservoir engineers at major oil companies help me understand this concept. Is over here on the left, or help me understand, how to understand reserve accounting that's disclosed in annual reports. This is the oil and gas. So think of this more so as non-OPEC. Oil and gas industries proved, develop, finding, and development costs. Well over 65 companies, both past and present, have gone into that blue bars on the left. And what you see is replacement costs have been rising for 3. And I will guess it when these Ks start dropping here, hopefully in a month, it's going to be a 4th year in a row. So that's the bars. And then oil prices is the line. And what you tend to find is there is a sigma band or a band on which oil prices will bounce off the floor. Does that make sense? So if the floor is falling like it was from 08 to 2020, then oil is going to make a series of lower highs and lower lows. When the floor or the replacement value for oil is rising, it's going to start to make a series of higher highs and higher lows until this whole competitive dynamics comes at play again. So what's the point of all this? Is over here on the right is if you were just to take oil price that you and I see on our screen divided by PDF&Ds, and that latest bar is around a little over $18 a BOE. If you divide the line on the left by the bars on the left, you get this line on the right, right? Just think about it, price relative to replacement costs. And that's been giving us our floor for oil. And that's why we bounced off the low 60s, because about a little over 3 times $18 a BOE puts you right around, I think it's $58 to $62. I haven't done the math in a couple of weeks. But that's why I personally think, because what happens is when oil gets around there, industry can't replace its reserves at economic price. So they just cut production and prices rally, right? So I think that's what's been happening there. That's a lot to unpack there, David. So I'll just sort of stop there if there's any questions or.
So this is essentially like looking at the F&D costs is
100%.
Initially is how I came across some of your research. And what I was looking at was the drilling rig efficiency from 2013 to current. And we've had essentially the quick numbers are in 2013, one rig in the state of Texas could do about 10,000 feet. And currently one rig can do about 37,000 feet a month. Right. So the drilling rig efficiency has considerably reduced the cost to be able to drill a well. And I was correlating that that the number of rig day reductions based on how much they would cost, so that total number versus the total number of barrels produced in the US, and that number came to about $8.70, or sorry, $7.27. And over the same time period, the F&D cost for Pioneer had dropped by like $8. So
From what period? From what period?
from 2013 to 2023.
Okay.
So I looked at the SEC SEC filings for Pioneer, and yeah, it was like, I think the overall drop was $8 and something, and then the correlated drilling rig efficiency, per barrel for the whole US though, came out to like, $7.20. So it was like the two numbers correlated fairly close, showing that it was that we were obviously making it significantly cheaper for Pioneer to find and develop. Right now, I know that's not the sole thing, but that was like, obviously those two values correlate fairly close to each other. So I guess my question is, after saying all that, do you think then, so what you're saying is that we're looking like an upcycle for F&D costs, and that is, I guess, two parts driven by one, lower tier acreage, like the acreage is just not going to produce as many barrels as the previous acreage, or increased costs from the oilfield service industry. So I guess it could be both of those items, even though Liberty did come out with their report the other day saying that frac fleet production per frac fleet is going up. So now it's not per well or per foot basis, but obviously there's a lot of variables in there. So I'm just throwing all of that out there just to be able to get your thoughts on it.
No. Like I think it's a very interesting topic, and it's pretty much the epicenter of oil. And to those in the industry, it's sort of like we know this. But you're correct, is that on this,
right.
this PDF&Ds along the left axis, on the left chart, if you can sort of see it, those orange bars are Pioneer. And you're right, they went from let's say $24 to, we'll call it just a share over $6 PDF&Ds by 2021. And that's the competitive dynamic within this industry is, unlike, I guess you could say, Gulf of Mexico, or unlike Alaska North Slope, the barriers to entry within shales in the Permian is a lot lower. Whereas the other, if you look at proliferation, the other, like traditionally speaking, it'd be a handful of guys that could do that. You just need to access the capital. A chart I had, I wonder if I can I upload a piece?
I mean, you could share your screen. You can.
Yeah, let me see if I can upload it. I hope I don't screw everything up here.
Don't worry, it's just the Vidor Locksmith show.
Okay.
You can't break it any more than I already have. And while you're looking up that, we got a couple of comments in here I want to be able to get to. Robert says, complex economics. Thanks for trying, Rob, but it's still over my head.
Trust me, it is for me too. And then also, a thing about this too is that I think the probably 85-90% of like what you'll read out there tends to a lot be very similar. So what I've always tried to do is try to approach it from a different angle to provide value for people. Because just simply repeating or approaching it the same way. So that's why I do like a lot of things different here. So this was let me get to the what I think. Now this will probably, I'll get a lot of head shakes. What I think has been the center of this productivity cycle. And it has a lot of interest. And I call this proxies over presidential preferences. This is a post I, did not that long ago. A lot of people liked it, but you can, if you want to understand, the rules of the game or Charlie Munger said it best. If I know the incentives, I can tell you the outcome. Okay. And the point is that the incentive structure has changed vastly over the last 10 years. And this is also why the theories that were floated out there in the back half of 24 that non-OPEC and shales are going to flood the market were completely false. It's, it's some, I don't know, econometric model sitting in his spreadsheet forecasting rig counts and productivities and yada, 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 yada. And so based upon this, here's this multivariate model that spits out that non-OPEC supply. No, like what you see here is if you were to dig through, and this at the top, this has over 20 E&Ps, and many are still not with us, but they were at the epicenter of the shale boom. Companies like Concho, Continental, and by not with us, I mean not in the public markets. WPX, Energen, and all the way on to Conoco, Diamondback, and what have you, is these companies, when they sit down and boards decide how they're going to pay the management teams, okay? They say, okay, we'll give them a salary, we'll give them an annual bonus, and then there's this massive stock awards we give them, right? And annual bonus factors, here's the set of metrics we're going to drudge you by. Okay. So if you hit production numbers, we're going to, that's a factor going in your compensation. We have some health safety. We can't have people dying out there. So, if you have less than whatever recordable incidents, okay, we have cash flow. So all these metrics go into there and that determines pay. So if I'm in a management team, I'm like, okay, I want to hit my metrics. Well, the point is that this shows you the average weighting among 10 U.S. focused E&Ps, oily, not gas. Gas is a little bit different. Oily E&Ps within their annual bonus incentive. Okay. So the bar on the left shows resource growth. So you want to think about that production, reserve growth, reserve replacement, production per debt adjusted share, whatever. You're drilling, you're trying to find more oil, or you're pulling more barrels out of the ground. You're growing. It's growth. Okay. Is what you saw in 2014, the average incentive weighting towards resource growth was over 30%. There are companies out there that were 50% of annual cash incentive bonus was 50% was towards resource growth. You incentivize the shale boom. Okay. That number right now stands at 6.9%. But as you see that little light orange bar, if you exclude Hess, and that's important to exclude for two reasons. Number one, Hess had to get the production numbers up for Guyana. So it's a little bit different. Production is probably more so in South America, but also Hess may get acquired later this year. So they're going away. Okay. Theoretically speaking, I don't know. I'm following that like everyone else. But if you exclude that, it's less than 3% as of 2023. And I have a feeling it didn't change much when the proxies come out here in the spring. So they're not incentivized to grow anymore. Okay. Man, you will not get paid. And it's not these shareholders voted after the crash. Okay. So what are they getting paid for is actually, if you see Capex controls is materially up, it's almost doubled in weighting. So what is Capex control? That's things like D&C cost per foot within the proxies. That's things like, we need to get F&Ds lower. That's things like just meeting Capex budgets, Capex to EBITDA, all these, basically all these things to control Capex. So they incentivized it. But if I were actually
beating up your suppliers,
what's up?
Beating up your suppliers.
Yeah, beating up your supplier, like that's all of the things. So management incentivized it versus 10 years ago. Now the other interesting thing here is over on the far right. This is what moves stocks. And this is why investors buy stock, and particularly energy, is, are you creating value? Are you creating higher returns on capital? It is the highest correlation to shareholder returns going back 100 years, more than any of these other metrics. In fact, resource growth has a negative correlation to total shareholder returns over the long run. In fact, value, things like returns on capital, ROI, cash ROCE, there's it can go by a lot of different names, but that used to be non-existent 10 years ago, and it's a rising proportion. Okay. So, my point is that, these companies are not incentivized to grow, but management did incentivize as you can see here, Capex controls. They did incentivize the productivity booms. But if I were to show you this, I'm still working on this data. If I were to show you the timeline, like sort of the weighting they're putting towards Capex controls is flattish to slightly down in the last year. Okay. Now, no one's going to agree with that, because E&P operators like, no, we don't want to be less capital efficient. Like, that's been the whole game, but the incremental has changed. Okay. So the way I measure like capital efficiency, and, I'm tracking this. Let me go to the last slide. Can we do that one, David?
The previous slide deck?
Yeah. The bigger slide deck.
There we go.
So the way I measure, and you could see this, like this productivity cycle, is that, keep that in mind, keep that prior incentive chart just in the back of your head, particularly as it related to incentives around resource growth. Remember, it was 30%. If you exclude Hess, it's less than 3 on the average weighting. Okay. And that's all the big names. Is that it's working. It's literally working. Is that this is US and NGL production by company for 23 plus E&Ps, as well as you have Chevron, Exxon, just US oil and NGL. And I have to include NGLs, I know, because within the company annual reports, they don't always break it out for us. It's only been recently. Okay. But this has not been the same growth rates that it was prior. You can see from 10 to 14, accelerating production growth. Same thing from 16 to 19. We had our bounce off COVID. We got to 6% growth, but it's decelerating. It's not the same, because these companies aren't incentivized the same way. They're not incentivized to grow. They're incentivized to protect returns on capital. Okay. Now, one way you can do that is obviously with being more efficient, as you well point out. But I think we have also seen this before, is that if I were to show you, there's a lot of slides here. Oh, geez. All right. So capital, like productivity, and this is another way to look at it, is what you're looking at here in the top chart is inflation adjusted upstream capital spending per BOE of production. So dollars of spend per BOE of production across the integrateds, the E&Ps, and even the Canadian oil and gas industry. Okay. So when it's rising, you're getting more capital intensive. And when it's falling, you're getting less. Make sense? more capital is being spent per unit of production. And what we've seen is all these metrics start to fall around that time, that incentive structures. Yeah, they peaked out around 08, but they started rolling over around 12 and 13, right when the incentive structures started to change. If I showed you a timeline of, incentives towards more efficient capital spending, you would notice that around then they started to rise. And so they incentivized it, but I don't think this is anything different within history. You can see that at least we were at these levels in the early 70s. Now, the point of all this is, I think this is pretty obvious. This drives oil field services revenues, which is the bottom half of that chart. And that's not just Halliburton, Schlumberger, that's everyone. That's the old, Baker, that's the old Baker International, Hughes Oil Tools, BJ Services, that's everyone. So I think that we are in the latter. Now, this is, a lot of people in industry are going to disagree with me, but I think we're in the latter stages of this productivity boom. But it's not been the first productivity boom within industry's history. And in the long run, I'd actually be more favorable. I talked about these three waves probably in the oil field services industry than many of the others.
Wow.
So that's a lot to throw. I'll just sort of stop there. We got some other charts, and the one thing there actually, a lot of us, I think we look at this, like you were talking about, drilling rigs versus production. You got these two lines that I don't know how you're looking at this. You remember Top Gun? We went inverted, but they've inverted. You know what I'm talking about? But I look at it differently a little bit because in pre-shales, we would just look at rig counts and that's going to tell us where production is going to grow, right? But that doesn't work anymore. But there are still some metrics that you can look at if you look hard enough, is that the Census Bureau, and no one really, I don't know why a lot of people don't, track this data, but the Census Bureau puts out some lovely stuff. And I used to cover Caterpillar and Deere. That's how I sort of knew about this source of data. But they put out orders for machinery and equipment within the mining and oil and gas end markets. Unfortunately for us, they don't just break out oil and gas. They lump it in there with mining. But what you tend to find is that this bars shows you orders on a trailing 12-month basis. And the light blue dotted line is the year-over-year growth. And the green line is U.S. oil production growth. And I knew this following Caterpillar, because Caterpillar sells to everyone in the oil and gas patch. They sell to the midstream, they sell to the upstream, they sell some in the refining. But when their orders would start to pick up, Caterpillar's orders would start to pick up, I would often notice that production rates would climb, and because they're putting power units on offshore drilling rigs, they're, supplying machinery orders to frac crews and what have you. And, they touch everywhere. But the Census Bureau data still is pretty darn good at telling you which way production's going. And it makes sense. It is, this, you've been on more frac spreads and drilling rigs than I have. It's a capital intensive stuff and they got to order new stuff. So if they're ordering more, production's going to go up. And if they're not, it's going to go down, these fleets get beat to heck. And this is why I think, there's a possibility that in 25 that production actually surprised most forecasters. The last time I looked at it, it's been a while, but most of the agencies had 2.5% growth. And I'm just like, the Census Bureau and the orders data, and the last one wasn't that great. It's not telling me that. So this is one area you could, when I first published this, it was the post was titled stop following the rig count, just follow this because it still works.
Golly.
That's a lot to throw at you. Even like there are some other data sources, like you just got to look what's going on in the job market. What you have here on the left, this is average. This is by the BLS, Bureau of Labor Statistics. Average weekly hours in oil and gas extraction is the blue dotted line. So just think about it. If you're out in the patch and you had to work 40 hours a week, but then your company's asking you to work 43 and then 45, you would think that would flow through into production. It does. It actually does. And that the blue dotted line is average weekly hours in oil and gas extraction, has tended to be a decent indicator on which way production growth rates for both oil and nat gas. Now, this is not just in the Permian. This is on a U.S. consolidated basis. But unfortunately, this chart is not updated, but that last blue dotted line actually plummeted. It actually plummeted. It's like down to around just over 41. And that just tells me that there's less hours being worked in the aggregate, not just, I'm not saying just Permian, but everywhere. So I think production is responding to the downside, whereas most agencies still have growth for 25. That's a lot.
Fascinating.
Yeah. So there are metrics so that's why, there are metrics that still work out there. The rig count the rig count stopped working once every drill bit, made a right hand or left hand turn and stopped going vertical. But things such as ordering machinery and putting people in the field, have not lost its relationship.
That's where I came up with the term rigflation.
Yeah, rigflation.
Because the thing I speak about is that the rig count it's a nebulous number. It has context for about, I don't know, maybe 3 to 6 months, but anything after that, it's like the value of a dollar, right? Like a dollar today is not the same as it was 20 years ago. So the rig count today is not the same as what it was, pre-COVID, pre-shale boom, 1980s, so I'm right there with you on that one. It's not a good metric for judging our industry or predicting what we're going to be doing in the future. I do have I got one. I'll throw this comment and then it will go back to what the question was before. Thanks, great discussion. Some amazing analysis. While drilling activity swings up and down, the production of oil and gas from wells is following a different trend. If exploration decline continues, then no new well campaigns being added, then the production will eventually abate. Food for thought.
So was that a sort of a question or a comment?
I think just a comment and maybe give your thoughts on as the drilling activity swings up and the production goes and down, the production of oil and gas from wells. So drilling activity is going up, but the production from the wells is going down.
I'm sorry, I just don't understand.
All right, Scott.
Put
your yeah, no, that's fine. I mean,
no, I agree with him on there's part of that incentive structure too is if you sort of read through all the lines, it also tells you there's no risk being taken in the industry. Okay, so our industry used to be you go out, you E, and then you P, right? You explore and then you produce, right? And that's just not it anymore. If you were to look at dry hole or dry holes relative to total wells drilled at these companies, they're like non-existent. They're non-existent. They don't drill any more dry wells anymore. Yes, technology has gotten better, but that's also the result of there's just no exploration and no one taking risks. And it shows up in the data too. Is if I were to show you, so that what this is, let's just focus on the blue bars, this is inflation adjusted not by CPI, but more about around an upstream capital cost index. It's an inflation adjusted exploration expenditures going back to 1956. And what you sort of tend to find if you were to study this is exploration spending recovers towards the back half of each cycle. That big uptick in the 70s actually started recovering around 77. And we were already almost a full decade into that cycle. And it started recovering again in 05, 06 last time. We're bouncing along industry bottoms, back to 92. So this is basically, the fruits of the offshore industry right here, these bars. And that's why I overlay it with offshore utilization rates. And so the thing is that, yes, exploration spending will pick up and it will bring about new basins, higher cost basins where they are. I don't think they'll be in the Permian, and I have my own historical reasons for it that could end up being wrong. But it'll be somewhere else, but they tend to pick up more in the back half. And then these higher cost, again, then we, as an industry, they figure out ways to bring the productivity cycle back in play and make them economical to develop. Like what Chevron's bringing on their production in Gulf of Mexico, like you couldn't do that. Like there was no technology to do that in the 2000s. Like they didn't have BOPs that could do that.
This, man, I'm gonna have to go back and watch this episode like 2 or 3 times to be able to soak all this in today. This is quite a bit. Yeah.
So I don't know, like sort of, I guess to sort of wrap it up, any other like just
there was
thoughts?
One other question I want to be able to throw out there. Scott asked, how are steel prices going to affect well construction costs?
Yeah, I mean, it is a major input. I don't have the exact percentages as far as like just steel prices, but it's also very labor intensive. And capital, everything goes into this. I'm sure you guys have seen the pie charts around it, as as far as D&C costs, tubular goods, and labor costs and rig costs. It's all part of the pie, and I think it's all going up. If you just want to, like, I'll sort of leave you with one of these charts. Like, just you hear these companies talk about malinvestment within the industry, and it's true. Now, let's see. No, that's not it. Wonder if it's here. Okay. No. All right. This is the reconstructed capital spending. So if you just go through all the cash flow statements that they give you, reconstructed capital spending on the left for the super majors, E&Ps, and Canadians, all the way back to 1891. And it goes back to 1891 and makes some estimates around Standard Oil based upon the balance sheet. I know it's not a cash flow statement. They didn't do cash flow statements back then. But you have the US E&Ps, the Canadians, and the super majors along the left axis. And then the NOCs are sort of jumbled up there along the right. And, the point is that they're growing Capex at single-digit rates, all of them, pretty much. No one's investing within this industry. And there's some of the lowest growth rates in well over 130 years. And same with the NOCs over there on the right. Now, that pink little dotted pop is just Pemex bringing on the latest refinery. But after that, there's pretty much nothing. And then obviously we all know about Aramco's announcement last year, but just across the board, no one's really spending or growing Capex at a rate to replenish assets. And another way to look at this is a little bit of, I wonder if I got it here, an accounting metric, but let's just focus on just the E&Ps. So on this left line is that Capex, if you know sort of your accounting, and I'll explain it if you don't, Capex, think about that as new stuff. You're buying new stuff, right? And then companies have DD&A, depreciation, depletion, amortization. To an accountant, that's using old stuff, right? So if you divide Capex divided by DD&A, old relative to new. Make sense? So
Yep.
That's what you're looking at here on the left. Since 1933, E&P's aggregate Capex divided by DD&A is the line. So when the line's rising, they're replacing assets. And when they're falling, they're not replacing assets. So, this is the entire thing that led to the productivity cycle that we're talking about, is, and that industry is concerned with. It's also not new, is that Capex to DD&A, I had to cut the chart off, but it was at 425%, an all-time high in the E&P industry in 2012. I mean, that's insane. Exxon, Chevron, Conoco, they've never done that in their history, but because the barriers to entry into the Permian and shales was so low, it attracted a lot of capital. Capex to EBITDA was that high. Capex to DD&A was at 4 times an all-time high. But we're bouncing along here at the bottoms. That's the productivity cycle, but you can clearly see that it's nothing new. And if anything, it looks like the productivity cycle, or Capex to DD&A replacement rates, is finding a bottom here. So I'll just sort of leave it sort of there, unless there's any other questions, David.
Honestly, I can't think of any other questions. This is just so much amazing information. I am so glad to have you come on the show today. It definitely seems like I need to go take a course in economics, oil and gas economics or something like that, because there's so much great data here to be able to look at and see trends of what's really happening. I think the one that really blew me away was the compensation for the executives. And I'm curious to see how that trends out over the next 4 years, especially with the HS&E and the ESG stuff that you had in there.
Yeah, I'll throw in a plug there. If people reading this or watching this, like, go out right now, go out, read it, buy it. Doug Terreson's Can't Deny It. Okay, it just dropped this year. And if you don't, he covered oil and gas on the buy side and sell side for 30 plus years. Like, on Wall Street, we have a term, like, you're the axe, like you are the guy to talk to. And it was his work that he published a report, I believe it was 2014, called The Pledge. And he made investors aware of all of this that was going on within incentive structures and what have you. And that drove a lot of these companies to pivot. And we are seeing that pivot. So, you're right. If I had in a crystal ball and I knew what compensation structures will look like in 5 years, I could tell you what the industry's going to do, what the stocks are going to do. Okay. I think it's that simple.
Wow.
You can throw your models away. It's that simple.
How did you find that information, though, on what the compensations are based on? Is that in the...
It's in the proxies. Yeah. If go to the sec.gov and, you can search for the 10Ks, but you can also search for a form filing. It's called DEF-14A. I have no clue why a proxy is called DEF-14A, but
So you can't find it.
Beginning, and many of these companies also have it on their websites. But beginning in 2012, that's why I can't take the charts back, say, 30 years. But beginning in 2012, they started to disclose more. They gave you more granularity on how they weighted things. Whereas before they would say, yeah, we think about production, we think about returns on capital, we think about free cash flow, and we have these discretionary measures and safety measures. That all goes into compensation. But right around 2012, they gave you the actual weightings and how it played out and how it all trued up to the exact bonus that executives got. And if you are willing and you like mindless torture, just sift through 20 plus companies, you'll come with that conclusion that the incentive structures are just different. The incentive structures are the material constraint.
Well, it sounds like I want to do that for the publicly traded oilfield service companies.
I did sort of leave you on that. I did a I know this is a very OFS heavy. It seems like, I guess, your audience tends to be a little bit more OFS heavy.
Well, I mean, operators don't participate in much.
Okay.
They don't have to. They've got a built-in client. Just the market will buy their oil, so they don't have to attend professional organization meetings. They don't have to go to conferences. They don't have to go to exhibitions, shows like that. So they don't need a marketing team. So they don't even those guys don't watch podcasts. Now, granted, there's probably a handful of them that might be watching today, and I appreciate you guys being there.
Let's see. I'm trying to upload it.
Oh, okay.
Here, let's get rid of that. Yeah, let's delete that.
But this is, I mean, this, and I'm a data junkie. Like, I love being able to find all the public data that's out there, and this is just blowing my mind how much is out there and things that you've been able to do. This is fascinating.
So the point of this chart was actually sort of like this post was essentially that we judge oil field service, at least on Wall Street, by, it comes down to international versus domestic, right? That's literally it. Like, if you're bullish international, you like Schlumberger or SLB or Weatherford, I guess, these days. And if you're bullish domestic, you're probably leaning more towards Halliburton or maybe some of the frackers, right? But that relationship, and that's because of over here on the left, what you're looking at is their international mix, SLB versus HAL since 1970. And obviously SLB has more international. I'm not telling you anything different, but if you look at how their stocks did relative to international versus domestic rig counts, there's not much correlation. So even though the street thinks of them that way, it doesn't show up in the equity performance. It's weird, but that's how we are groomed and obsessed to think about OFS. But what actually drives, and this is the number one thing here. This is across everyone. This is across the integrators, the refiners, the E&Ps, the OFS, the drillers, everyone. It's shareholder value add. And that term gets tossed around a lot. But what shareholder value add means in its purest sense is returns on capital in excess of your cost of capital. So, for example, David, if you're borrowing from me and your cost of capital is 5% and you invest that in capital, you better make over 5% or you're destroying value, right? And
Yes,
if you are, your stock's going to go up. If the spread is rising, it's the best metric on how to judge these companies, especially the big two, SOB and HAL. What you have here in this top chart, the blue dotted line, and this is how major holders across buy-side institutions think about not just OFS, but any industry that goes into their portfolio, okay, is they have to invest capital, and they don't have to just choose oil field service. Their menu across the entire equity market is wide. So anything that's hurdling the cost of capital by a wider margin is going to attract more capital, and less is going to be the source of funds. And what you find here is these blue dotted lines, you got SLB on the left and Halliburton on the right, is simply returns on capital minus the cost of capital, the way I calculate it. And that very much closely correlates to total shareholder return, price plus dividends. If you can exceed your cost of capital, it's going to go up. Your stock is going to respond well, right? And that's been the case since, I think that's 1949 for Halliburton on the right, and I have to zoom in, is that 58 for SOB on the left. So, and if you actually notice, according to this metric, now I think the consensus out there is we're more bullish on international because of A, B, and C, whereas there's a lot of headwinds on the domestic front because of X, Y, and Z and yada, 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 yada. I mean, you know this, like it's pretty consensus, but according to this metrics, HAL is delivering, yes, it's still negative, but they're closing the gap to creating shareholder values faster than SLB is. Why is that? Maybe it's because on this chart, their incentive structures are more heavily weighted towards returns on capital or value creation metrics. Okay. So what you're looking at, and this can get complicated, but again, you have SLB on the left and HAL on the right, and this is all in their proxy statements. This doesn't go as far back, but it gets the point across, is that depending on how you want to group them, the orange bars is things like health, HSC, health, safety, ESG metrics, strategy related, whatever, blah, yada, yada. And then you have green bars, which is profit growth. And the way that can be a lot of different things, but think about just profits. That can be earnings per share, net income, EBITDA, free cash flow, operating cash flow. It's a lot of different metrics, but we're talking about profits. But you have to measure profits relative to something, profits relative to capital, and that's a value-based metric. So things like return on investment, returns on capital employed, returns on capital, shareholder value add. Halliburton, you can see over the right within not only their annual incentive bonus weightings, but the long-term incentives and structure is entirely focused on returns on capital, where SLB is less so. So again, incentives are driving outcomes.
This is great stuff.
So,
man, wish you lived closer. I'd love to just dig through a bunch of data with you. All right. Wow, guys. Let's see. I do have a drill bit to give away. We'll go ahead and wrap up here. Rob,
drill bit? Let me see it.
Yes. Yeah, we've got a little 3D printed drill bit. I'll send you one, man. I'll send you one.
All right.
Don't worry about it. All right, guys. We'll do the drawing real quick. We don't have a sponsor for the show as of today. Hold on. I need to present. Share screen. Streamer giveaway tools. Share. Go back over here at the stage. There we go. Come over here. Click the thing. Go back. There we go. So,
cool.
Thank you guys for watching today. I do appreciate it. We do have, like I said, a drill bit to be able to give away, and our winner is Sadali. Thanks for watching, sir. I do appreciate it. we will get in touch with me. Shoot me a message, and we will get you a drill bit sent off here shortly. There we go. Rob, so much amazing information. Thank you so much for being on the show today. Truly, truly, truly do appreciate it. For everybody out there watching, next week we've got Tony Peak and Taylor Maddie on the show. Both guys that are focused on the geothermal drilling industry. After that, Demetrios from Weatherford, then Robert Van Kolkenberg. No show because I'll be in Norway for the SPE conference. And then after that, Eric Caillou, drilling engineer of the year for 2023, I believe. Award from SPE. So he'll be on the show. Thank you guys all for watching. Do truly, truly appreciate it. Thanks for all sticking around and watching today's show. That's it from me. I got to find the little button to click here. Where did it go? There you go. Media and assets. There we go. All right. Like I said, that's it. Lots of little technical glitches there in the beginning, but thanks for everybody for watching, and see you guys all next week. And as always, know your industry.